here. Tonight I'm going to talk a little bit about business valuation. And I'm with a firm called American ValueMetrics. We're a team of 5 from San Francisco to San Diego. And we do the business of business valuation. So what are we valuing is one of the questions we'll talk about tonight. What is a business? What are the elements of a business? What are the value drivers? We're trying to develop the value and the methods. How do we go about coming up with the number? What is fair market value? The analyst job, so what we do when we put our green hats on and go look at the numbers. Litigation support, and some of the current issues that are happening in the business valuation field. So what are we valuing? A business is an economic engine that converts an investment into a stream of profit. And it changes over time. So we have the economy, we have management plans, we have markets that change. So it's got this future which is undetermined, it's got risk. And so that's why we say the future is at risk. It's also a complex enterprise. It's got multiple subsystems. So you've got production and sales and marketing, and you might have quality control and logistics. There are many, many different pieces that go together in a business, and they all have to function together and function well. So what we do is we step back from that and we try to create a financial model of the business. We take that economic engine, we take the investment part, and we see how it changes it to profit. And the value is driven by 2 things. One is cash flow. That's the wealth creation part. It's the money it pushes off every month or every year. And the second thing is the rate of return. So that's a measure of the investment risk. Cash flow is something called EBITDA, or a term called EBITDA, plus non-cash add-back. So we figure this out. If you're not familiar with the term EBITDA, that's earnings before interest, taxes, depreciation, and amortization. When you run into this term in financial news, when you're running a company, if you have an executive boss, he's going to say, how are you managing your division? And I want to measure you by this EBITDA, which is your cash flow. And one note on EBITDA, net income is not EBITDA. So when you see net income reported in the paper, those are things that have non-cash events in them. So management can manipulate net income, they can't manipulate the cash flow. That's why we look at cash flow. The second item is rate of return. This is called either a capitalization rate or a discount rate, depending on whether we're looking backwards or forwards. So if we're looking backwards, we call it a capitalization rate. And if we're looking at a future, a predicted key stream of cash, we discount that stream back to the present to come up with our number. So as a business takes in its investment, it takes its capital and converts it to profit, the capital gets depleted and it needs to be replenished. This cap rate or discount rate is basically a measurement of the time and the risk it takes to consume that investment and start turning a profit. I don't see too many blank faces. Okay. So cash flow and capitalization rate, they work together like the bond market. So they, in terms of real estate. So you see interest rates go up, payments go up, so you usually can afford less house. Same thing happens in the bond market. So when rates go up, value goes down. And when rates go down, value goes up. So when you have lower risk, you've got a more valuable business. One other thing we look at is positive free cash flow. It's a test, particularly for growth companies, because what we want to make sure is you don't run out of money somewhere along the path in the future. So in the case of a growth company, you're having to put more capital into the company as you get launched and you keep on developing that investment. And you'll see in a lot of business plans, there are points where they don't have enough money, they run out of money. So you hear about rounds of financing. So as the business grows, with a startup gets going, you're going to see rounds of financing. When you get to that point where you need more money, that's what free cash flow analysis is about. It's understanding whether or not you're going to run out of money in your business plan. So we like to check that to make sure, even if you have a going concern that, let's say, 2 years down the line, it's really a dead end. Okay. So we want to go forward.
Not moving for you, huh?
Frozen.
Frozen. Like that.
Doesn't happen very often.
So the one thing
Oh, there we go.
about
Okay, try again.
yeah. There we go. One thing about our field, it's more like a class. I don't have great pictures to put up for you to describe what we do. We'll talk a little bit about valuation methods. A lot of people have rules of thumb. You'll hear 5 times EBITDA, 5 times cash flow. You'll hear 3 times cash flow plus inventory. You'll hear professional services going for 1 times book, their book. Rules of thumb we find are okay for businesses under $500,000 revenue. The assumptions that people make when they're doing a valuation by rule of thumb is it's a simple business. It's usually got a single line of business. It's not that different from other businesses in its field, and it's pretty much got limited growth potential. Change any one of those assumptions, and the business could be a lot more valuable. We do 3 approaches to valuing a business. You've seen these approaches in commercial real estate appraisals. The income approach, the market approach, and a liquidation approach. The school that developed the valuation for businesses is the same one that developed the standards for real estate appraisal. In the income approach, we're taking that cash flow and that risk rate, and we are converting that to a value. So we take the historical cash flow, how the company is performing, and we develop the risk rate, and we take the cash flow and come up with a number. The market approach is the same analysis, but we look at comparables. So now we look at the industry, we look at other companies doing the same thing or similar things, and we come up with a capitalization rate on the same cash flow of the business. We do that in a comparative basis. And the third thing we check is the liquidation value. Sometimes, and I just ran into this last week, the business isn't generating enough money, so it was actually worth less than the assets on the books. So if you have a ton of trucks in your company, you might have $1 million worth of trucks, but you don't have enough income to make the business worth buying. So a buyer might come in and buy your trucks and keep the business going if there's a future in it. But generally, when you get to that liquidation number, you don't have enough income to have a value more than your assets. So anyway, we check that, especially in cases where the numbers are low. 2 other approaches are the discounted cash flow approach. It's a similar analysis, but this is the one where we look in the future. We take the business's business plan, and we bring that number, that stream of cash flows from the future back to the present. And the replacement approach. This is kind of similar to the liquidation analysis. We look at what it would take to recreate the business as it sits. And both of these valuation methods are typically used for startups. So they don't have any history. So what we have to do is look at their business plan, and then we look at how much they've invested to this point. If they're coming up with a new technology or a new software application, what did it take to create that and get them to this point? And so these 2 things are used. These are about the only 2 things you can use for a startup. And I just said that. since we based on future cash flow, the startup value is in the business plan. No historical record. One little tidbit here is about how risky startup ventures are. An entrepreneur, a serial entrepreneur, is typically successful 18% of the time on his first startup, 20% on his second, and 30% on his third. So when you start doing this analysis, we come up with a range of values. We've got a lot of variables in the business. We also have buyers and sellers. They've got different interests, competing interests. And those two things have to be resolved in a negotiation at some point. So the numbers are not an end in and of themselves. It's to give the negotiation legs on either side, whether you're a seller or a buyer or an investor. From the valuation elements, it's clear that we got two things we're watching, right? I said it, the risk and the cash flow. So here is the model. So you can get an idea pictorially that you're going to have a large value when you have small risk and big cash flow. Comparatively, you're going to have a small value when you have large risk and small cash flow. The other factors that are going to affect what's going on supply and demand and the strategic value of the business to somebody else. So we got this range of values from the buyer to the seller, so the price is going to be in the middle. Pretty common sense, right? So the buyer wants to be here, the seller wants to be there. In this case, we have a strong seller. He's got maybe better knowledge or better financing. The buyer might be weak. And so the price pushes away from this fair market value to what it sells for. Fair market value is a theoretical. So we got this complex process. It's going to give you imprecise, uncertain results. So to actually complete a valuation, we actually limit the scope of what we talk about. We come up with this concept of fair market value, which is out of tax court. And it is the price at which property would sell with a willing buyer and a willing seller, all with perfect knowledge of the situation. And that's the unrealistic assumption that goes into fair market value. So fair market value is an opinion of value. It's never the exact value that you can actually see something happen from. So we continue to further define purpose when we look at the valuation, and we do that in order to figure out, to come up with these different ranges. So we have a big range of values. Statutory is what we typically would do for an IRS valuation. So they are usually minimum defensible value because you want low value, but there are some times where it's maximum defensible value because you want to step up the basis for a state. Market is that fair market value. That's the theoretical. Buyer and seller come to an agreement. Investment. So if you have an investor come in and he's going to bring in a bunch of cash and amplify the business plan, it's going to change those future cash flows. So we're going to have a bigger value in an investment situation. And then there's the strategic buyer. And once again, that amplifies the value of the business because they're usually gaining control. They're taking over the business plan. And it's typically a buyer's analysis. So we might have someone come in and say, hey, I want to look at these three companies and how they fit. So we might do 3 different valuations to help them decide which one to go after and how to negotiate. So a strategic buyer, why are they willing to pay more? Well, first of all, they're typically a partner. They're usually your client or your supplier. But they're willing to pay more because they can get reduced competition. That means higher prices. That means bigger cash flow and less risk. Strategic customers, they might just want to buy a customer who's a big influence in the industry. It could be acquiring technology or talent. There times where you have assets that they're just not being used enough and they can leverage them better. Or to reduce costs and improve buying power. So, it always comes back to the cash flow and the risk. How does it affect those two variables? So Waze is being bought by Google. They use mapping technology from a cell phone. 4-year-old company, 67 million in it, 47 employees. What's it worth to Google? Any guesses?
50 million, I'm just kidding.
Okay. $1.3 billion.
Yeah.
19 times capital investment.
Same thing happened with YouTube.
Similar, right?
Yeah.
So who knew? Google's internal valuation team, who was figuring out the ways to leverage the technology. And they're looking at the competition, that supply of buyers and sellers. Maybe it's Microsoft, maybe it's Google, not that would, but Sun, maybe someone else is going to step in and take that. So they came up with their value to keep it, to play keep away from other competitors, but they also had to maybe pay. So they found the leverage in that technology in a big way.
So what did they do your map?
They take cell phone data and they're transmitting it and collecting that data to create mapping and where you, they know where you're sit, for example, because of your GPS signal. So they're creating mapping data off of those signals.
Wow.
Here's another one. We call this the irrational seller. So we got a founder of a company. He's been in it 30 years, longtime member of the industry association. Rules of thumb industry. Says it's worth 3 times earning plus inventory, which is $7 million. Does he get it? That's the right answer. Does become with the number. He gets it. Now in this case, it turned out he didn't account for the fact that his company was different from those rules of thumb. That it had grown so large, his cash flow had put him in a different class of multiple. So the buyer came to us on this one, and the owner didn't want to share in the valuation and come to a common number. He didn't want us, it was $10,000 valuation. He left $3 million on the table for a $10,000 purchase. So at some point, there's a risk in these negotiations that good advisors, people you want to have on your team. The angel investor, we talked a little bit about startups. The flip side is the angel investor and what he's looking for, and everybody wonders, how do you get that money and what do they do and why do they take so much of my company? Number one, their money is basically being locked up. 5 to 10 years is typically how long they will never see that principal that they're putting into the company loan. They're expecting a 70% failure rate. So remember those entrepreneur numbers? 70% is their plan. So they go into 10 companies to ensure that they're going to get a return. So 7 can fail, 3 can be winners, and they need to see 10 times return on that business plan. So it gets them 3 times what they actually invested back. They're all said and done. But that's only a 25% return on your money over 5 years. So these venture capital people come in and want to get a big chunk of your company. That's the reason. They're looking at large amount of failures and really not great return if they hit their average. Now, if they get a 10-bagger that goes to a 100-bagger, now they're happy. You know, that's what they're looking for. But it's a numbers game. So the other side of the negotiation is always interesting. What do we do? All the stuff I've been talking about, this is what we sit down and we determine. So we go and we determine those cash flows from the financial statements. Financial statements are basically done for tax reporting. They're really not done for valuing a business, so we have to recast those. We determine the capitalization rates. There's some market information. There's historical information. There's market comps that we do that. We'll look look at that business plan. Sometimes we have to help the owner put a business plan together for the next 5 years in order to figure out what the value of the company will be moving forward. Then we put these market comparisons together. So we might have 40, 50, 60 companies to pick from that are similar. We have to match the comparisons to the company. So we get a good comp. Just like on real estate. You don't do a 4-bedroom house versus a 2-bedroom house in 2 different neighborhoods. It's the same thing. So then we got to prepare those approaches and reconcile them. We pick the ones that are best for this situation. And there's other discounts. If you have a minority position, you don't have control of the company, you can't really sell your stock. In a private situation, there are discounts that will happen after that. That's a whole other topic. Accreditation. So our field was recognized as a separate appraisal discipline in '78. And we have about 50,000 professionals out there in the United States who are doing this at least occasionally. 10,000 are actually accredited valuation analysts. There are 2,000 full-time firms like American ValueMetrics, and there's 300 master analysts in financial forensics, and that's our managing partner. He's one of those 300. About 150 practice, and they're the guys who go into court because they can decipher all the elements of valuation and defend it in front of you. Standards, you might have heard of USPAP before, the Uniform Standard of Professional Appraisal Practice. We have the same thing as commercial real estate. It's not required for business or equipment valuation, except when federally regulated activities are going on, SBA loans or the classic. The differentiators are a USPAP, and we're a USPAP compliant firm. Requires market comparisons, and it must be a self-contained or a full report. So all the logic and the arguments for what your opinion is are in the report. You'll see from CPAs and a lot of academics, you'll see formulaic type of approach to valuation, along with algebra equations, things from public markets. There are arguments that we have in our field about whether these things are appropriate or not. But USPAP requires that market anchor. Litigation. So what makes an opinion valuable in court is the fact that it can be defended. So courts are generally saying, show your reasoning. So you can't walk into a court with one of these formulaic appraisals and defend it. Don't just throw it out. And one way to prove defensibility is to consider the different ways to approach it and make sure they're all included in your analysis. And that's something that we do. So we don't just pick one or two analysis at the beginning and say this is how we're going to do it. We look at the world of it. Some of them we don't even like, but we put them in there because other people use them. Dauber challenge is another thing that happens at court, and that's basically the opposing counsel coming in and say, hey, throw this guy out, he's not an expert. So that's the other thing that happens in court. They try to knock us out, but proven appraisers, as opposed to people, like I say, with formulas or accountants who are doing it for time, will be able to hang in there. Current issues, private equity. So we've got a lot of changes in the business in terms of private money is moving into growth companies as opposed to using public markets for raising money, at least for the first few rounds of growth capital. We have government attention, so they're looking for taxable events and they're looking for third-party valuation on recognizing what different financial instruments are worth, and fair value accounting. So due to some of the crises and things we've had in the last 2 decades, they want the numbers on certain financial reports to show what things are worth today, not the tax basis for what they are. So book value versus market value can be dramatically different. In the old days, private equity was the family business, it was a regional market, it was pretty stable, didn't have a lot of capital needs, no intellectual property, and this is what would cause the valuation. We could have a sale, be an estate plan, or a dispute between shareholders or a divorce. Today, the private equity companies have ongoing needs for capital. So they have things like stock options for management. They have investors with preferred stock. They do acquisitions. They have intangible assets and intellectual property that needs to be valued. And they have things called impairment. So as the value of the company might go down, and an asset may be impaired. So valuing the private equity venture really just takes the same kind of things that we get in our old-fashioned business valuation. We need to understand the business, we need to define the risk, and we need to identify the techniques we need to determine the value of the private enterprise. It doesn't come from public markets. Then we have, I think we mentioned this a little earlier, but there are a number of academics who are coming out with formulaic approaches, and they use elements like betas out of public markets, and those are derived from public data in fluid liquid markets, and we deal in illiquid markets. Okay. Fair value accounting, also called mark to market. It's about having the right value today for your assets on their books, and it reflects these conditions here. The pros, it more accurately communicates current value. It does self-correct over time. The best platform for communicating enterprise value to investors. And the cons, it makes the owner's equity really volatile, goes up and down. There's an added cost for the recurring valuation of assets, and the tax basis, reporting basis may require separate accounting. So these are the takeaways for today. You remember one thing is the first thing, decrease risk, increase value, because risk and value work in opposite directions. Fair market value, the second thing, it's an opinion, it's a judgment. Negotiation happens between players, and there are other factors, strategic for investment, or even just the knowledge of the players that go into what actual transaction goes for. If you prepare like you're going to court, you rarely do. In the private equity world, we've seen much broader use of private funds compared to public, and use caution with these formulaic approaches. They can be useful. You just need to watch where they're being used. Thank you.
Thank you, Jim.